questions. Before we get started with this panel, I do need to make one comment on the last. I did think it was funny, and by funny I mean ironic, to hear a Yankees fan complain about the Dodgers spending a lot of money. And as a Kansas City Royals fan, small market team, I'm particularly sensitive to that issue. So just wanted to get started on that note. Well, I'm delighted to be here moderating today. I'm Lori Bettinger. I'm the president of BancAlliance, which is a network of community banks. And we have a great group here today. We have Eric Newell, Isaac Wheeler, and Scott Hildenbrand. I'm going to go ahead and let everyone introduce themselves quickly. And I will start with Eric, who is my neighbor on stage and my professional neighbor in Maryland.
Yeah, Eric Newell. I'm the CFO of Eagle Bancorp. That's the holding company of Eagle Bank. And we're headquartered in Bethesda, Maryland, and we serve the district, Maryland, and Northern Virginia.
I'm Isaac Wheeler. I lead our balance sheet strategy group at Derivative Path. Derivative Path is a hedging technology and advisory company working with about 250 banks around the country.
Scott Hildenbrand. I work at Piper Sandler. I spend my time working on balance sheet management strategy and a little bit of the M&A in the capital market space as well. So they're all kind of connected.
Great. And I just wanted to let everyone know this panel is going to be open for discussion. You know, we'd love to have Q&A. We can cover it at the end. If anyone has questions as we speak, you know, please feel free to ask as we go. We're going to have people will be walking around with a microphone. So if you have a question, just raise your hand and the microphone will come to you. But, you know, feel free at any point to join in the dialogue. So to begin with, I think right now there's been a lot of discussion about how we have a bit of a perfect storm in balance sheet management, where you have sort of repricing debt for many banks, still underwater securities portfolio despite, you know, some recent rate cuts, and pricing models that can't necessarily keep up with a fairly volatile environment. So Eric, I'm going to start with you. What keeps you up at night as a CFO?
What keeps me up at night? Not any of those things that you're mentioning, because I spent a lot of time being in Washington, D.C. thinking about office loans, unfortunately. But our panel isn't about credit, so I'm going to take advantage of not talk about that, unless somebody wants to ask me about it. I think, you know, in terms of the changing interest rate environment, you know, Eagle in particular, our balance sheet, we're a value add lender, so the duration of our assets is shorter with CRE. So you have some of those assets are repricing, and they're going to reprice into lower yields here with falling interest rates. So I think the idea of understanding where to pick duration if we want to extend duration on the asset side, or more importantly for us, and we've been spending, you know, the bulk of the last 2 years reworking the liability side of our balance sheet. You know, we've been historically funded more on wholesale and brokered than is desirable for the NIM that we need to have, and so really focusing on continuing that, building relationship deposits, and also making sure that we're picking the right duration on the liability side given the interest rate environment and what we expect or what the market's expecting is going to happen.
That's great. Isaac, I'll go to you next. Same question. What's keeping you up at night?
Yeah, I would say that, you know, compared to when I first joined our firm, it felt like we had to do a lot of selling to our clients as to why hedging was something that was worthwhile. And one positive thing that came out of 2023 was, I think the average bank, you know, gets the utility of hedging, understands it. But if there's one kind of unique part to that story, it's that I would say 90% of our flows over the last couple of years have been from banks that had exposure to rising rate environments. You know, I think those are the banks that see the value of hedging. They're the ones that have seen margins compressed. They're the ones that have now kind of taken action to hedge. And maybe if there's one segment of the market that hasn't really thought about hedging necessarily, it's maybe the institutions that have had margin expansion over the last years. There hasn't really been a lot of impetus, I would say, outside of the big regionals to hedge in that direction. And a big factor I think that drives that is that, you know, hedging strategies of all kinds will have some sort of immediate day one income statement impact, and, you know, the strategies for better or for worse that have been popular over the last few years have been the ones that are either accretive to income or minimally impactful. So I'd say, you know, it's probably something that will always keep me up at night, but maybe that, you know, institutions by and large continue to do the hedging strategies that are cheap from a year one earnings standpoint or cost nothing. And maybe that's, you know, not specific to this cycle, but I think something that I think about frequently.
Same question? All right.
Yeah, same question.
So for me, the way I would think about it is the word that keeps me up at night is the word when. I think a lot about what all the banks in this country went through over the last 5 years. You think about it, the Fed borrowed every bank balance sheet in the country, dumped a ton of cash onto your balance sheet. You all kind of have to sort of reacquire yourself through this process over the last 5 years. And so it's been really interesting. But I think what I've learned through this is it's so funny. We use the word strategy a lot. And I don't think anyone in this room doesn't know how to handle an interest rate risk move or a balance sheet management move. I think the real question is not how, it's when. When do you put the strategy in place? Preparing your board, preparing management to think about when is what I obsess over, to be honest with you, and keeps me up at night for sure.
I think one of the things that Isaac just mentioned about the cost of the hedge is just trying to help educate internal constituents or the board. The fact that it's really an insurance policy, so it's like, how do you assess the cost-benefit analysis and tying those two? And I found success in when you do that, you can help better understand, is the premium for the insurance policy worth it? I don't know if.
Yeah, to Scott's point, and I think it goes along with what you said too, in left to their own devices, when for a board is when the problem comes up, right? So I think the dichotomy of probably all these strategies and the irony of it is that, the time when you want to do something is too late, right? So to Scott's point, it's training yourself to be cynical, to think about what we're not talking about, to discuss possibilities that the market's not pricing in yet. That's probably the reflex that people need to build.
Yeah.
That's a great point. And Scott, I'm going to start with you on this one. So I know we've heard a lot about this wave of coming sub-debt refinancing. I think for some banks it's here. So I'm just curious, in the room, does anyone have sub-debt that was issued maybe in 2020, 2021 that's going to be doing some form of resetting in the coming months or year? All right, the lights are bright, but I see at least one hand.
Yeah. Wow.
So what strategies are you recommending to clients that might be in that situation? What are you suggesting that they consider doing?
Well, so Lori's point's a good one. I think, as we all know, a lot of folks did issue debt in 20 and 21 at all-time lows in rates, which was great. Spreads were tight. And I think the first strategy or discussion is to get your board comfortable with the fact that we're coming up on 5 years. So for most folks, we're losing a little bit of regulatory capital after that. You're also going from fixed to floating. So there's multiple decisions going on, I think, within the balance sheet. I think the real question becomes, do I go back to the market, go out to the market now? The market is wide open again. I've been surprised, actually, at not only non-bank buyers, but the bank buyers of this debt again, driving spreads down. So we're seeing a lot of folks come into the market again. And I think what you're doing is you're making a decision. No matter what, you're making a decision. You're either letting it float and slowly losing a little bit of regulatory capital. You're going to go refi, or you're going to pay it off. And I think I've seen all three. So I think those are decisions. If I'm an investor in the stock, in the company, I start thinking that's a real decision they're making about growth, about their balance sheet, about their prospects. And so you're also seeing a lot of these capital raises, whether it's debt or equity, paired with balance sheet restructurings to kind of get yourself back in line and ready for 2026 to sort of dig out of the trouble that a lot of folks were handed through 2023. So I'd say I'd say most folks are still out there issuing. I'd say the one point that I think is important is you'll hear your board, and I've been in a lot of boardrooms, you'll hear a board member, he or she always knows where rates are going at all times. It's fascinating that you all have one of those. But what I find interesting when you get to the debt raising conversation is people don't talk about spread, right? We issue at 4%, we're heroes. We issue at 7.5%, and we stink. And it's like, well, wait a minute. If I issued at 4, what was I doing if I put that in cash? Earning basically 0. Now today, if I issue at 6.5 and put it in cash, it's somewhere around 3. Think about that spread. And so as we all know, we're all spread managers at our core. And so I think that's the real discussion. Lori, it's around use of capital, it's pricing and spreads.
And just following, you said that you've seen banks follow all three paths.
Yeah.
Are there any sort of commonalities in banks that take one path versus another, or is it pretty idiosyncratic to the institution?
I wish I had a better answer for you. I think everyone is a little bit unique in that sense. It's a lot about growth and a lot about what to do with that capital. So I have seen all three, but I would tell you that we're probably leaning more and more to the refi wave now, given where rates and spreads have come in over the last 6 months. I think people have been somewhat happy with those levels. So I'd say that more and more are now kind of keeping their eyes open at these levels start to come down.
Got it, that makes sense. Eric, is this something you've had to address?
Yeah, at Eagle, we had a maturity on our 10-year sub-debt last year. And it was, at that point, there was a tremendous amount of uncertainty about credit and office for Eagle. And it really ended up being a test of having investors get confidence about the credit portfolio. We made a decision early on, actually late in 2023, that we didn't want to pay it off. We wanted to reissue and keep that Tier 1 capital at the bank. So I spent most of my summer with a team, and we went on, we partnered with Piper. You guys led the deal, and Jacques is amazing, and he helped us refinance that, and we ended up expanding our disclosure tremendously on office. And if you pull up our investor deck, you can see all kinds of data that makes us almost look like a REIT in our disclosure types. But that's what we needed to do to get investors comfortable to make that investment in senior debt. So we pulled it off, and it was a lot of work, but it was important for us to keep that regulatory capital at the bank.
You learn a lot about management and folks like Eric. He won't say it, but the amount of disclosure and transparency in difficult times can be scary, right? But it's really serving well. And I do applaud you for that, because that's not easy. It's not easy to stand there and say, yeah, we've got this and we've got this, but we're plowing through it and we're fighting through it. So
yeah, thanks, Scott.
Isaac, anything you wanted to add on this?
Not necessarily. I've looked at everything from a hedging lens, and I would say maybe one thing that's kind of been interesting that we've seen is, banks are bringing on new fixed rate liabilities, for all the reasons that Eric and Scott have talked about. One thing that's interesting to me is just within our client base, how many of those clients have immediately turned around and swapped that debt back to floating? So, if you're raising sub-debt, and a big, reason why you're raising the capital is to, execute some sort of restructuring in the securities portfolio, you might be going a lot shorter there. You might be a lot more asset sensitive as a result. So something that I guess has trickled down to my lowly hedging world has been the swapping of that sub-debt back to floating. So, you can still float and get, the capital treatment you're looking for on a new issuance.
That makes sense. And you brought up our next topic, which is, the underwater securities portfolios and options that banks have in this situation. So again, in the spirit of getting some audience interaction, I'm curious, and we'll go with the official hand raise poll here. Who here is a net seller of securities year to date? We have a few. In case anyone's curious, if you look at Copilot and you ask them, about moderating panels, they suggest a lot of asking the old-fashioned raise your hand polls, which I think is a very funny thing that AI is telling people to raise their hands. Okay, so Isaac, when you encounter banks with this challenge, how do you see some banks look at securities portfolio hedging as potentially an alternative to, having a sale, maybe taking a loss and just sort of, deciding to do the one-time sell, announce the loss, maybe raise capital or sell, a different component of the bank? I know we saw one of those transactions this week. Does hedging enter that conversation in your experience?
Yeah, I would say that, hedging investment portfolios was very in vogue in 2021. That was probably when, hedging against rising rates, I think we've seen a lot of it. Like I said, 90% of the activity we've seen over the last few years has been hedging against rising rates, but it's almost always been from the perspective of earnings. So we're liability sensitive, we've got earnings risk, we want to hedge that. A lot of those banks, maybe as a happy accident, also find that there's kind of a positive impact on OCI, which helps the securities portfolio get offset. But hedging expressly for the purpose of hedging the investment portfolio's value in a higher rate environment is not something we've seen a lot of, although it's starting to come back. I think there's a couple reasons for it. One of them is that the long end of the curve has started to misbehave a little bit. There's term premium that's starting to get baked in, and maybe there's a recognition that as the Fed cuts rates, the long end's not necessarily going to move lower at the same time. Actually, the Fed cut rates a couple weeks ago, long end's higher since then. Same thing happened last year. So I think there was maybe this growing realization that Fed rate cuts aren't necessarily going to bail banks out of maybe some underwater marks on the securities side. And in fact, actually, I would wager that if we see a substantial change to the Fed, I'm not saying that that's likely, but imagine the Fed becomes much more dovish and maybe cuts rates, 100, 200 basis points, what have you, like what Myron is advocating for, I bet you the long end will go higher. So I think that possibility is starting to enter our clients' minds, and we're starting to see more hedging for that purpose in a way that we haven't the last couple of years. The other way that we're starting to see securities portfolio hedging is in the context of M&A. So if you're a target bank, you've been acquired, and you know that you're going to sell the securities portfolio on legal day one or shortly thereafter, I mean, you know you're going to sell the entire thing. You maybe as the target bank have to bear the cost of any negative change to your investment portfolio between announcement and close. I mean, it's a very clear-cut, I think, case for hedging, and we've seen some banks, like Bank of California last year, do some hedging around some assets they were going to sell after their merger with PacWest. So I think that's the other framework or the other area where hedging investment portfolios has started to come in. And I think we'll start to see more of it as well, especially if the long end continues to maybe drift a little higher. That said, again, I'm a hedging firm. We think about hedging all the time. I'm a hammer. Everything looks like a nail. I'm sure Scott and Eric will have other thoughts on what to do with underwater portfolios.
Scott, I'll go to you next. What do you advise people with?
Sure. I think the first thing, so as many of you may know, I'm on an airplane every week, and I have the lovely job of getting to walk into boardrooms and say, you should take a loss. So I'm very well appreciated when I come in. But I think one of the things I often talk to boards about is that you've already taken the loss. Let's be very honest with ourselves. You've just decided to amortize it through your margin over the next 6, 7, 8, 9, 10 years. So I think the first question becomes, are we better off ripping the Band-Aid off or not? And I think that's the first question. The second question, and it's from an investment banking outlook, I think there was some mistakes made as well. When you come out and you sell securities that are already on your balance sheet, you've already factored in the earnings stream off of that. When you sell those securities, there's no earn back period. The earn back period is nothing more than the weighted average life of the assets you sold. You are selling very liquid assets in the market. And so you're either deciding to amortize it, as I said, or rip the Band-Aid off, but either way, you've kissed your sister at best. I think the real question becomes when you look at these restructurings, you have to improve earnings in the future, sure, but the word A&D matters, end. What else are we doing with our balance sheet going forward for recognizing the loss now instead of bleeding it later? And I think a lot of people get twisted into pretzels, especially in boardrooms, because I'll have that same individual board member, he or she will say, well, Scott, we're really conservative here and we've never taken a loss. And I'd love to say, you're taking it every quarter, we can see it through your margin, let's talk about the differences of Bank A versus Bank B and decide from there. So I think there's some misconceptions around earn back, because people in the investment banking world, right, you announce a deal, you want to say the earn back's around 3 years, everybody gets excited. I'd rather you show me on a bond restructuring a longer break-even period, 7 years, 8 years, go get the problem. Don't get the short stuff. Get the stuff for 2% for 7 or 8 years and rip out the real problem if you're going to go down that route.
Lori, we should have added another chair here to have an institutional investor to come up and argue with you.
Oh, nobody, by the way, nobody likes my point of view. Okay.
That would have been fun.
Yep, I've had many of arguments.
Because I've had several institutional investors say, don't you do that trade, Eric, because we haven't done that at Eagle just because we've been focused on regulatory capital preservation, but it's not lost on me when you look at our pre-provision net revenue and what we could do to improve that is a loss trade, for sure.
And I remember in 2023, a very smart investor who I follow, the question was, would you do a restructuring? And he said, absolutely not. I don't want any of my banks to do it because rates are going down. That scares me a little bit because we sat through all of 24, we're almost through 25, and I would argue if you knew rates were going down, I'd do it right now. Go get 5% assets at 0 to 20% risk weighting, locked out, protected, if you actually knew rates were going down. So there's a little bit of a dynamic, and you can imagine some of the arguments I get into.
Yeah, I'm sure.
So Eric, it sounds like you've definitely done a lot of thinking on this topic as well.
Oh yeah, a lot of thinking on it. I think I'm probably more in Scott's camp than maybe some of the institutional investors out there, but it's something that when I think about pre-provision net revenue growth, you're right. I mean, we're kind of the losses there, at least on the gap side, and we're just bleeding in over time. So it's definitely a tool that I think is worth considering seriously.
I guess, Scott, back to you. I mean, given sort of the challenges I get having institutional investors and being publicly traded versus being private, I mean, do you find that if you're advising a privately held bank, they're sort of more likely to potentially take the rip the Band-Aid off approach?
No, I actually flip it. I think it's the other way around, interestingly. Because if you think about a publicly traded bank, for the most part, Eric and I were chatting about this a couple of minutes, there's no secret. I know you own 1.5% to 2% yielding securities. And by the way, you're marking them if they're available for sale through your OCI. And OCI is nothing more than the opportunity cost for owning a bond at 2 in a 5% market. That's all it is. So that's why I don't get so worried about the loss. It's an opportunity loss. Eric's going to get his money back on the securities that are at 2%. And so I think that's an important sort of point. But I think when you talk to a publicly traded company, there's a lot of pressure and a lot of understanding around this loss. I think at the private side, there's a little bit less transparency. And so it's almost a little bit more like, whoa, you want to come in here and tell me that we're taking a loss? And then you start getting into dividend discussions. And also, honestly, where loss trades go to die is when you start talking about executive comp. And I'll leave that alone. As you can imagine, I'm nobody's friend, but yeah, just honest.
Well, I'm sure that, but between coming in and talking about the loss and executive comp, it would make you very a very popular person.
Yep. Internally or externally, I have no friends.
I'm your friend, Scott.
Thanks, Eric.
And before we move on, I'll just see any questions. Okay, don't see any at the moment. So another topic that we wanted to cover today was the evolution on loan pricing models. I know that some of the updated pricing models try and incorporate capital allocation, funds transfer, pricing and expenses, trying to capture liquidity premium in models, economics of optionality, for example, charging your borrowers for prepayment options, which can often be given freely right now. So how do you think about that, in such a volatile environment where your pricing models might not be quite up to snuff? Like, how does that impact how you're thinking about the balance sheet? And Eric, maybe I'll go ahead and start with you again on this one.
Yeah, I mean, it's very much a critical consideration for us. I joined Eagle about 2 years ago, and when I got there, the pricing model that was in place was actually quite mature and well established, pretty well thought out. And it addresses many of the things, Lori, that you mentioned, where it's allocating capital based off of the level of risk. Liquidity premium, no, and it currently doesn't have a liquidity premium, but our new corporate treasurer has been educating folks internally about what a liquidity premium is, with the expectation that will be implemented maybe in next year in 2026, just because it is pretty impactful by implementing that liquidity premium. But the funds transfer pricing, helping educate people internally on understanding match pricing, and we're not going to compensate the line for taking interest rate risk. That's the responsibility of corporate treasury. But it's pretty well established, and we've done a lot of education to help people understand what's in the model, why the model is important. In our management loan committee, pricing, not just loan-only pricing, but the entire relationship pricing is discussed. As you all likely know, deposits are highly accretive to client profitability, and particularly an organization like us where we need to grow those relationship deposits. We use that model to help drive the behaviors that we need from our relationship managers. And what's really critical, for at least in my point of view, and something that we did implement shortly after I got there, was the tying variable compensation of the relationship manager to the profitability of their book of business. And so, we're now in year 2, where the part of the annual incentive comp for a relationship manager is growing the ROE of their book of business. And it's not just ROE in a numerator denominator sense, but it's also the actual dollars, because we didn't want some adverse selection activity to occur. But the idea really is to just drive those relationship managers to value the deposit almost more than the loan, because that's where you're getting your franchise value for the organization. So now kind of went off in a little bit of a tangent there, but I think for us, it's been great to educate internally on what these models are and why they're important and how it drives important behavior, and then pay them for that behavior.
And I would assume that tying incentives to that has made the adoption of them and the willingness to understand what's going into these pricing models much stronger.
Yes, I think the critical point there is you don't want it to be a black box. So our team has built reporting, Power BI reporting, where a relationship manager can go in and look at the profitability of their book of business at any point. So they can see what the profitability of their book was last year and what it is year to date, and then they can also drill down to the relationship level, and they can see where there might be opportunities for improvement there.
That makes sense. And Isaac, do you have a number of discussions on this? I know sometimes when we talk about loan pricing models, some of them try and incorporate, the role of customer hedging as part of this.
Right. Yeah, no, I think we have a very, interesting lens into this insofar as you have a commercial customer of the bank is doing a swap as a part of a loan. My colleague Frank Fiorelli, who's here, who works with our clients on this point, can probably speak more intelligently on this topic than I can. But one thing that's interesting, I think, first and foremost, is that lenders want to close loans. So I think to Eric's point, building a structure around the pricing mechanism such that they have to go through these steps is key first and foremost. So I think the structure around those processes is important. In the customer hedging world, I think one other interesting thing that happens is that the value of optionality gets very much exposed. So customer loan is, in a sense, just a floating rate loan and a swap that's delivered alongside it to help fix a rate for a client. And as a part of that, you lay bare exactly what to Scott's point on the investment portfolio earlier, like the opportunity cost of that loan going away is very clear. If a customer wants to prepay, the bank has to bear that expense and the customer has to fund it with a prepayment penalty on their side. Another interesting thing that comes up though is that often banks will ask us, hey, I've got a deal and the customer wants the right but not the obligation to lock in this rate for any time over the next month, but they can walk away. Like, what's that worth? And the answer is, hundreds of basis points, basically completely eliminates any profitability on that loan potentially. So there's, I think, interesting things that I observed there, just human nature. I mean, we're not running around with option calculators in our minds. We don't realize how valuable these options are. Customer hedging is one way to make it very clear to a bank what it's going to cost, but there are, I think, a lot of other methodologies that Eric mentioned that go beyond just commercial loans that have a swap associated with them. You can do that with, any type of loan related to the banks originating.
That's one thing, Isaac, that you brought up that we're starting to talk about internally more is educating on the value of that optionality, those prepays, and even the structure, normal 3-2-1, and the cost of that versus other types of ways that you can build in optionality. And when our relationship manager comes in and says, well, we're going to refinance the loan and it's going to stay on our balance sheet, but you talk to our corporate treasury area and they're like, who cares? Because we still have the funding on the other side and we can't prepay that funding on the other side. And that value of that option, it could really wipe out the profitability of that loan for the entire life of it.
A lot of adverse selection to your earlier point.
Yeah, no, and I think too, Eric, your point, and Isaac deals with this a lot, so if I mess this up, yell at me. But if you think about the hedging world in general, 10 years ago, when actually I used to do some of it, remember that, most folks would just use swaps. Pay fixed swaps, no problem, we all understood it. You pulled from a strength to address a weakness, right? We were either an asset-sensitive company or a liability-sensitive company. Those days are done. We're just sensitive because we're short options everywhere. Right? You really think about technology and education around your customers. They know the minute they can refi, all of that. So we always stress, I really believe if 10 years ago, 95% of our business in the hedging world was swaps, I think in 5 years, it's probably going to be 50% and 50% options, where banks need to start getting long options to deal with the convexity risk, the optionality risk that a lot of folks are facing, because the largest banks in the country are coming down in the market. And they are not embedding floors. They're not doing things like that. They don't care. They don't rely on spread as much as we do, right? So we've got to think a little bit differently too and be proactive around adding options, being long options, instead of constantly being short.
And there's some options you can't avoid selling, right? The deposit side of the balance sheet, mortgage book, you have to sell options somewhere. So to your point, you have to buy them back just to be flat.
Anywhere, yeah.
And Scott, in your discussions, particularly with boards, do you generally find that banks are currently using sort of loan pricing models that you think are capturing, a lot of what they should, or do you still find that many of them fall short if you're taking a hard look?
Wow. Again, I'm not going to be anyone's friend again. I don't think we're doing it as accurate or as effective. I still think ultimately lenders are paid to lend, right? So immediately you worry about that. I also worry about spreads because you think about the dynamic. Everybody 5 years ago grew artificially, 20%. Now we're sort of like refiguring who we are. We're also issuing capital in the debt form. Anybody who I'm competing against as a bank, my top 10 competitors, anybody that's raised debt, guess what? Spreads are going to be tighter on the lending side. And we need to have that discussion internally, whether we care about quality of earnings and growth or is it quantity. Quality versus quantity is a big discussion in the loan markets. And so I feel like sometimes spreads are what they are, and you have to actually make a reactive decision. Because I'm pretty sure if Eric's bank doesn't make the loan, there's probably 7 other banks right behind it, and you've got to make that decision. So again, I think it really comes down to what Eric is talking about, the digging in the relationship and relationship pricing, which some folks nail it. I think some struggle a little bit because they want to show growth, but not all growth is valued equally and created equally.
Mm-hmm.
Yeah. And I mean, we touched on growth a lot in this most recent discussion. How does growth look to you in a lower rate environment?
Well, I think what matters to me and the way I think about it is, I care less about nominal rates. I care more about the shape of the yield curve, right? So let's start with that. I think I obsess over the spread between Fed funds and about the 5-year area of the yield curve. And historically, over like a 35-year period, there's somewhere about positively sloped about 85 basis points. We've been in the wrong way for a long period of time. So I think if I'm a bank right now, I'm thinking about 2 ways that could actually be positively sloped, and I'm thinking about strategically how to prepare my bank to handle that movement, right? It could be great, it could be negative, it doesn't matter. What matters is I need to understand the yield curve risk that's on my current balance sheet and where my growth's going to come from, and then design strategies around it. So it's a little bit less about rates coming down, it's a little bit more about the shape of the curve. And typically most of the banks I work with, about 80% of their spread business is driven off of only 20% of the yield curve. Find out the drivers of your spread business and figure out 20 to 30 basis point moves. If you don't have answers around strategy and what you're going to do and when, that's where I'd spend my time. Instead of talking about being asset or liability sensitive, I don't really care. I think it's the shape of the curve and what drives your spread business.
Yeah, I agree with Scott, because when you think about duration of equity, we haven't really been paid lately to take duration, and with a positively sloped yield curve, you're going to be able to get paid more for that duration of taking some duration of equity or growing that. And it's just, when I think about growth in a lower interest rate environment, it's not quantity, it's quality. How do you grow that pre-provision, that revenue, and be responsible and maybe taking some duration and getting paid for it?
And I think also as you look at the forward curve, the Fed will, the market's pricing it in at least, if the Fed continues to cut rates the way it is, we will have a positively sloped yield curve 1 year from now. So I think the interesting thing in our world has been, a lot of banks are taking it as a given that the Fed will cut rates. The curve is giving you an opportunity to potentially lock that in. You don't have to wait for the Fed to actually deliver on these cuts. You could just say, well, the market's giving it to me, I'll take it while I can. That's been, I think, something interesting that we've observed. And we've also seen the market, I think, get ahead of itself repeatedly over the last couple of years. We've been pricing in rate cuts for a very long time. Now it feels like we're closer than we've ever been, but time will tell. Hard to say without any economic data right now either.
Well, yeah, I think to Isaac's point, the market always expects things that are going to happen much quicker than they always do, generally. So, then you have that carry that you can take advantage of in the meantime. But, yeah.
I would argue too, I think sometimes some banks confuse strategy and tactics, right? Tactics are knowing what to do when it's right in front of you. I think everyone's prepared for the Fed to move rates lower. I think that's been pounded out there a few times. I think strategy is knowing what to do when it's not clear and concise and in front of you. So I think a lot more preparation around some of these alternative scenarios probably makes some sense right now. whether it's length of time to get to the curve, right, or how much movement. But those are the folks that I enjoy working with because they already know what they're going to do when the forward curve is wrong, which we always know it is wrong. You know, that's the one thing you can count on. So I think there's something there.
Okay, thank you. And I was just going to follow on that. I mean, I think certainly, as you all said, in a time where expectations are not necessarily met within the time period we're expecting them to, have you found, you know, in discussions with banks or, you know, with your board that, you know, people are trying to do a better job of preparing for that uncertainty? Again, you have your likely outcome, but then you want to be as agile as possible across, you know, multiple ways to get there.
Yeah, absolutely. I think, you know, for an asset liability nerd like myself, who spent my first 20 out of my first 25 years, I spent not really seeing rates move at all. I think the last 5 has actually been kind of fun, right? Everybody told me how great higher rates were going to be. It was fun for about 3 weeks, and then we had bank failures. But I think what we've learned through this process of 0 rates and 550 basis point rates is, and I think a few folks have mentioned on some of the earlier panels, we have to prepare, right? You can't predict. You have to prepare around those multiple scenarios. And so even in the M&A world, where I spend a fair amount of my time right now, it's not just slapping 2 earning streams together like it used to be 20 years ago with a cost save and move on. It really is, okay, by the way, when we close this thing, what can we do and where's our exposure here? Is this earning stream real, right? And that's the challenge I think buyers have right now as they're looking at targets.
I think to Scott's point too earlier about when, you know, I think if you don't have those conversations ahead of time, inevitably the conversation in a boardroom or at ALCO or with management will be, you know, people's biases will come into play, right? If you don't have a plan ahead of time, if you don't discuss, hey, what are we going to do if the Fed doesn't cut and actually hikes as its next move, right? Or the long end of the curve goes to 6%. If you don't have that conversation ahead of time, then that one boardroom that has a view on rates is going to be, you know, the loudest voice in the room. And I think that's where kind of human nature will start to trickle in, and I think the desire to try and predict and bet will kind of override maybe what the bank should do ultimately.
The hardest ALCOs I've been in have an economist in there, and I'll leave that alone.
I think it's important also in order to have the appropriate conversation to be prepared, you need to make sure you're informed adequately, and that's all about the model and the assumptions that go into the model, and ensuring that the data that you're putting in is accurate and well supported, because that's going to be hugely important for making those decisions and having those conversations.
Strategy can't come from the outside, right? It comes from within the model and your own balance sheet. Your balance sheet will tell you where the strategy needs to go, but anybody who calls you and says the market's doing this, that relative value means nothing. It's relative value to your balance sheet, and there's a big difference there. And that's why some people, like a lot of my friends at least, they'll always ask, well, why did banks do this or that? I'm like, you don't understand spread management at all. Everybody else in this country thinks about asset management. They don't think about spread management, and it's a very big difference. And so I think a lot of boards screw that up too at times. They think about asset management, they obsess over the asset side instead of really thinking about it from a spread management perspective.
I think earlier on when we were asked about what we worry about, and just to piggyback off Scott's comment there, you know, I think in, again, my own world, but I'd imagine there are parallels to, you know, the rest of the strategies that fill Scott and Eric's day. You know, in the hedging space, you know, yes, banks are hedging more. They're doing more to manage risk. They kind of get the joke now. But one thing that remains true, and I think will change over the next 5 to 10 years, is that, to Scott's point, right now I think a lot of clients of ours need a story from the outside. It's a conversation about relative value. It's a conversation about, hey, you should do this because a lot of other banks are doing it. And the number of banks that we work with that say, hey, we're going to do a $50 million swap this month because our ALCO model told us we should do it, and that's the end of it. A single-digit number of clients of ours out of 250 that think about hedging that way. Rest assured, JP Morgan is not waiting to hear about what B of A has done to manage their interest rate risk. They've got a team and they say, well, model says this, I do it. And that's how you really eliminate, you know, conversations about trying to predict rates, conversations about guessing where rates are going. You hedge reflexively. It will make my job much more boring when our clients behave that way, but I do think that longer term that's the way we'll head, and perhaps in other areas of the balance sheet too.
That makes sense. It's the difference between maybe being more proactive versus the fast follower approach, which seems to often be the default. So what just as our last question here, what is one thing that if you could tell banks to look at, one thing on their balance sheet to really focus on that you could see helping them improve in 2026? And let's give people to Monday. So if everyone's going back to their office on Monday and taking a look at one component of their balance sheet, what do you want it to be? Isaac, I'll start with you.
I was hoping I was going to go last. Scott, why don't you, I'll kick it over to you for a moment.
Yeah, sure. For me, I would say, and I always challenge boards to do this, I would look and go back and think about what your deposit base looked like in kind of 2018, 2019, and then take a snapshot of where it is today, and then go a little bit deeper. I'm obsessed over this loyalty versus trust concept, right? And I think about my dad's generation. My dad has banked at the same bank for like 50 years. He's got an enormous amount of loyalty. But the arguments we get into, if I hand him a check and I can say, get your phone out and just, deposit it. He's like, nope, no way. Someone's breaking the Wi-Fi. I will never do that. He drives down to the branch, puts his check in. Enormous amount of loyalty, very little trust. You flip it on its head and you think about kids that are born after the iPhone was created. Or ask your interns why they bank where they bank. You should see the answers I get are outrageous. It used to be, Scott, I bank where my parents bank, or I bank because there's a branch on campus. Now the answers are, I got a 1-year free subscription to Spotify. The individual didn't pronounce the bank name right. I asked them where it was. They didn't know. There's a dynamic shift here, and I focus on the deposit side. I think the asset side we can get our arms around. It's really the deposit side and the needs of loyalty versus trust and what the makeup of your deposit base is trending to. And so I think that's going to play a role as we think about the next 5 to 10 years.
Yeah, the duration of a depositor is definitely shorter even in my career now than it was when I started. And we're primarily a commercial bank, but though I think about it from the perspective that as the generation shifts and the 40 and 50-year-olds take over for the businesses, they're also being influenced by technology. Right. So I think as a commercial organization, we have to understand how those entrepreneurs and CEOs and CFOs of those organizations are going to interact and bank when they're running their business. So we're focused a lot on the consumer side, and I know of folks that work on my team and they bank with Venmo. That's their bank. They get paid to Venmo. It's wild to me because you're calling an 800 number, you don't have anyone to talk to, and that's one of the things that I kind of still rest my laurels on for a small business banking customer client. They don't go into the branch very often, but when there's a problem, they want to call somebody. They don't want to call an 800 number. They want to look at somebody because they need to get their people paid or they need to pay their vendors. But I think that the theme that you bring up, Scott, about where I think we all need to spend time thinking about is the duration of that deposit. And that's what's driving a lot of franchise value for banks. It's not the asset side, it's the funding side.
I go to a lot of golf charity events for different banks. You know who's always there? The big asset borrowers. That's backwards to me. It should be your best depositors. That's who you should be rewarding or spending more time with. To Eric's point, it's always backwards to me a little bit.
I think, not to drag us back down into the world of tactics, but I think to Scott's earlier point, I think Eric touched on this as well. I think my one thought, and what I tell clients, especially going into next year, is you have to be cynical and you have to do a little bit of backcasting, right? You have to say, look, if we get into trouble next year, margins compressed 100 basis points, maybe we don't get the sub-debt issuance off like we were hoping to. We still have the same underwater securities portfolio. Ask yourself, how did we get here? And what should we have done earlier on in the year to avoid it? I think there needs to be a little bit more cynicism and a little bit more imagination as to what can happen. I think the last few years have been a great lesson in humility for all of us in terms of predicting the direction of rates and maybe some of the other dynamics on the deposit side. And I think that having a little bit more imagination and talking about the scenarios proactively is important.
Great. Well, thanks so much. Any final comments or responses to Isaac?
No, all good from my perspective, yeah.
Yeah, I'm good.
Excellent. Well, thanks so much, everyone.
Thank you.
Thank you.